A crisis does something peculiar to the human mind. It creates urgency where patience is required. It manufactures panic where calm analysis should prevail. And it convinces otherwise rational people that they must act immediately, decisively, and often recklessly, precisely at the moment when careful thought matters most. I have observed this pattern across many decades and many market cycles. When employment becomes uncertain, when prices rise faster than wages, when headlines grow darker by the day, people find themselves gripped by a particular kind of confusion. They know they must do something. They feel the weight of their financial situation pressing down upon them, but they cannot determine what to do first, what to do second, and what to postpone entirely. This confusion is not a character flaw. It is a predictable response to genuine uncertainty. But it leads to a question that I hear constantly in one form or another. Should I pay off my debt first, or should I invest while prices are low? The question itself reveals the confusion. It assumes these are two competing choices of equal merit to be weighed against one another like items on a scale, but this is not how sound financial thinking operates. The correct order of operations is not a matter of personal preference or emotional temperament. It is structural. It follows from the logic of risk, obligation, and survival. Let me be direct with you. Most people asking this question are not truly asking for analysis. They are asking for permission. Permission to invest because investing feels like hope. Permission to ignore their debt because debt feels like a chain they would rather not examine. Permission to believe that a falling market represents an opportunity they cannot afford to miss. I understand this impulse, but I cannot grant that permission because it would be a disservice to you. The disciplined path is not the exciting path. It does not promise rapid transformation, but it is the only path that reliably leads to financial security, and financial security is the foundation upon which all opportunity must rest. Today, I will present to you a framework for thinking about this question. Not a prediction about markets, not a guarantee of returns, simply a clear order of priorities that makes sense regardless of economic conditions, but becomes absolutely essential during times of crisis. This order is not negotiable. It is not flexible based on your feelings about the market. It follows from first principles about risk, safety, and the nature of financial obligation. The person who understands this order and follows it with discipline will not become wealthy overnight, but they will survive. They will maintain their options, and when opportunity genuinely presents itself, they will be positioned to act from strength rather than desperation. Let us begin by understanding what risk actually means. The word risk is used carelessly in financial discussions. People speak of risky investments and risky decisions as though risk were a single, simple quality that some assets possess and others do not. This is a dangerous oversimplification. When I speak of risk, I refer primarily to one thing: the probability of permanent loss, not temporary fluctuation, not paper losses that recover over time. Permanent, irrecoverable damage to your financial position. This distinction matters enormously. A stock that declines 30% during a crisis has not necessarily inflicted a loss upon you. If the underlying business remains sound, if you have no need to sell, if you can hold through the turbulence, then the decline is merely a quotation, a price offered by the market that you are free to ignore. The loss becomes real only if you sell or if the business itself fails and never recovers. But consider a different situation. A person loses their employment during a crisis. They have no savings. They have significant credit card debt at 18% interest. The payments continue regardless of their employment status. Within months, they must sell their investments at depressed prices simply to meet their obligations. Now the paper loss has become a permanent loss, not because the market declined, but because their financial structure forced them to act at the worst possible moment. This is the true nature of risk in household finance. Risk is not found primarily in the volatility of your investments. Risk is found in the fragility of your overall position. And debt is the great multiplier of fragility. I developed a concept many years ago that I call the margin of safety. In security analysis, this refers to the gap between the price you pay for an investment and its intrinsic value. The larger this gap, the more room you have for error, for unexpected developments, for being wrong in your analysis without suffering permanent damage. But the margin of safety applies far beyond stock selection. It applies to your entire financial life. Your margin of safety is the buffer between your obligations and your resources. It is the space that allows you to absorb shocks without catastrophic consequences. Emergency savings represent a margin of safety. Stable employment represents a margin of safety. Low fixed expenses represent a margin of safety. And the absence of burdensome debt represents perhaps the most important margin of safety of all. When you carry significant debt, especially high interest debt, especially variable rate debt, you have reduced your margin of safety. You have committed future income to past decisions. You have given others a legal claim on your resources. And you have created a situation where temporary difficulties, a job loss, an illness, an economic downturn can cascade into permanent financial damage. This is why the question of debt versus investing cannot be answered by comparing interest rates to expected returns. That calculation ignores the structural reality of your situation. It treats your finances as a static spreadsheet rather than a living system subject to shocks and uncertainties. The person who invests while carrying toxic debt is not being aggressive. They are being fragile. They have exposed themselves to ruin from multiple directions simultaneously. A market decline hurts their portfolio. A job loss makes their debt payments impossible. And the combination of both, which crises often deliver simultaneously, can destroy years of financial progress in a matter of months. Safety must come first, not because I am conservative by temperament, though I am, but because the mathematics of ruin are unforgiving. You cannot compound your way to wealth if you are forced to liquidate at the bottom. You cannot take advantage of opportunity if you are drowning in obligation. You cannot think clearly about investment when you are terrified about making next month's payments. The margin of safety in your personal finances must be established before the margin of safety in your investments becomes relevant at all. Before we proceed to the proper order of operations, we must establish a clear understanding of debt itself. Too many people treat all debt as morally equivalent, either condemning all borrowing as foolish or accepting all leverage as sophisticated. Neither view is correct. Debt exists on a spectrum, and your treatment of different debts should reflect their position on that spectrum. At one extreme, we find what I call toxic debt. This category includes credit card balances at 15, 20, or 25% interest. It includes payday loans and similar predatory instruments. It includes any borrowing where the interest rate substantially exceeds any reasonable expected return from investment, and where the terms are punitive, the fees are hidden, and the compounding works relentlessly against you. Toxic debt is not merely expensive. It is mathematically hostile. At 20% annual interest, a debt doubles in less than 4 years if unpaid. No prudent investment strategy can reliably overcome this headwind. The person who invests while carrying toxic debt is attempting to fill a bathtub while the drain is wide open. They may see water accumulating, but they are losing the race. The next category involves variable rate and unstable obligations. This includes adjustable rate mortgages, certain business loans, and any debt whose terms can change based on market conditions or lender discretion. These debts may seem manageable today, but can become crushing tomorrow. When interest rates rise, as they often do during certain crisis conditions, these obligations grow precisely when your ability to service them may be declining. Variable rate debt introduces a particular kind of fragility. You cannot plan around it reliably. You cannot know what you will owe next year with certainty. And in a crisis, this uncertainty compounds your anxiety and reduces your ability to think clearly about your options. The third category comprises secured debts with reasonable terms. A 30-year fixed-rate mortgage at a moderate interest rate falls into this category. Such debt is not toxic. The rate is locked. The payment is predictable. And the asset securing the debt, your home, provides genuine value to you and your family. This debt still represents an obligation, still commits future income, still reduces your margin of safety to some degree, but it is fundamentally different from credit card balances or adjustable loans. Finally, we have low-rate fixed debt, perhaps from an earlier era of lower interest rates, perhaps from specific favorable circumstances. This debt may carry interest rates at 3, 4, or 5%. Mathematically, one might argue that investing rather than paying off such debt makes sense, since long-term investment returns have historically exceeded these rates. I do not necessarily disagree with this calculation in principle, but I would offer a caution. The psychological and behavioral costs of debt often exceed their mathematical costs. Debt occupies mental space. It creates anxiety. It reduces your flexibility to make changes in your life. And during a crisis, even low-rate debt can become a burden if your income declines or your circumstances shift unexpectedly. A family carrying no debt whatsoever can survive on far less income than a family with even favorable obligations. This optionality has real value that does not appear in spreadsheet comparisons. Let me share with you a brief illustration. Consider two families, each with the same income and the same net worth on paper. The first family has $200,000 in investments and $150,000 in mortgage debt at 4%. The second family has $50,000 in investments and no debt at all. On paper, the first family is wealthier, but which family can more easily weather a job loss? Which family has more options if they need to relocate for work or care for an aging parent or start a business? Which family sleeps better at night? The mathematics of debt are not merely about interest rates. They're about flexibility, optionality, and psychological burden. In a crisis, these factors matter enormously. We arrive now at the central framework. I will present to you a priority stack, an order of operations that applies during any crisis and indeed during any period of financial life. This order is not arbitrary. It follows from the logic we have established about risk, fragility, and the margin of safety. Do not reverse this order. Do not skip steps because you are excited about investment opportunities. Do not convince yourself that your situation is special. The order exists precisely because human psychology tends to push us in the wrong direction toward hope and excitement when discipline and patience are required. Asterisk, asterisk. Step 1, stop the bleeding and create a cash buffer. Asterisk, asterisk. Before anything else, you must stabilize your immediate situation. This means examining your cash flow with complete honesty. Where is money leaving your household? Which expenses are essential and which are optional? Which subscriptions have you forgotten about? Which habits are draining resources that could be preserved? Stopping the bleeding is not glamorous. It will not make you wealthy, but it creates the foundation upon which everything else must rest. Simultaneously, you must begin building an emergency cash reserve. This is your margin of safety against life's inevitable shocks. How much is enough? There is no universal answer, but I suggest a minimum of 3 months of essential expenses, and preferably 6 months or more if your income is unstable or your industry is volatile. This cash should be genuinely liquid, not invested in stocks, not locked in retirement accounts with withdrawal penalties. Actual cash or its equivalent available within days if needed. I recognize that building such a reserve while facing financial pressures seems paradoxical. You might argue that you should invest this money, or that it could earn more elsewhere, or that you cannot afford to let cash sit idle. But consider this. The emergency fund is not idle. It is working constantly. Its job is to purchase your peace of mind, your flexibility, and your ability to make good decisions under pressure. No investment return can match the value of not being forced to sell at the bottom of a market or accept a terrible job offer because you are desperate. The disciplined investor builds their cash buffer first, not last. They do not skip this step because they are eager to buy stocks at low prices. They understand that survival must precede opportunity. Asterisk, asterisk. Step 2, destroy toxic debt. Asterisk, asterisk. Once you have established a minimal cash buffer, perhaps 1 month of expenses as a starting point, you must turn your attention to toxic debt with focused intensity. Every dollar of credit card interest you pay at 18 or 20% is a guaranteed loss. No investment reliably returns 20% annually. By paying off this debt, you are earning a guaranteed return equal to the interest rate with no risk whatsoever. This is the best risk-adjusted return available to you. Attack this debt with every available resource beyond your essential expenses and minimal emergency fund. Consider balance transfer options if they genuinely reduce your interest burden without hidden fees. Consider selling assets you do not need. Consider temporarily reducing lifestyle expenses to accelerate payoff. Do not be gentle with toxic debt. It will not be gentle with you. I recall a family I once advised many years ago who came to me with a modest investment portfolio and significant credit card debt. They were proud of their investments and reluctant to sell them to pay off the debt. The portfolio might go up, they reasoned. The opportunity might be lost, but the mathematics were clear. Their credit card interest exceeded 15%. Their portfolio had no guarantee of returns and indeed might decline. By maintaining both the investment and the debt, they were effectively borrowing at 15% to invest in uncertain assets. This is speculation, not investment. And speculation with borrowed money is the path to ruin. They eventually followed the disciplined path, liquidated the portfolio, paid off the debt, and began rebuilding on a sound foundation. Within a few years, they had surpassed their previous net worth, but this time without the fragility of toxic debt. Asterisk, asterisk, step 3, stabilize and simplify your obligations. Asterisk, asterisk. After toxic debt has been eliminated, examine your remaining obligations with an eye toward stability and simplicity. Can variable rate debts be refinanced into fixed rates? Can complex payment structures be consolidated into simpler arrangements? Can insurance coverages be reviewed to ensure adequate protection without excessive cost? This step is about reducing complexity and uncertainty in your financial life. Every variable you can convert to a fixed quantity reduces your exposure to surprise. Every simplification reduces the mental burden of managing your finances and frees your attention for more productive purposes. Negotiate where negotiation is possible. Many lenders will adjust terms for borrowers who approach them proactively and honestly. Many service providers will reduce costs for customers who ask. This is not about being clever or adversarial. It is about taking responsibility for optimizing your financial structure. Consider also whether your housing and transportation costs are appropriate for your income. During boom times, people often expand into larger homes and newer vehicles than they strictly require. A crisis is an opportunity to honestly assess whether these commitments still make sense or whether downsizing might dramatically improve your flexibility and security. Asterisk, asterisk, step 4. Begin or resume defensive investing with clear rules. Asterisk, asterisk. Only now, after establishing a cash buffer, eliminating toxic debt, and stabilizing your obligations, are you prepared to invest with discipline. Note that I said defensive investing. This is crucial. The investor who has just navigated the first 3 steps is not in a position to take aggressive risks. They have established their margin of safety and must now protect it. Their priority is participation in long-term wealth creation with minimal exposure to permanent loss. Defensive investing means broad diversification across asset classes and geographies. It means low-cost index funds rather than active trading or individual stock selection. It means automatic, consistent contributions regardless of market conditions. It means ignoring the daily fluctuations of prices and focusing on the long-term trajectory of your wealth. Here is where I must discuss what I have called Mr. Market. Imagine that you have a business partner named Mr. Market. Every day, he offers to buy your share of the business or sell you his share. Some days he is euphoric and offers high prices. Other days he is despondent and offers prices that seem absurdly low. His moods swing wildly and unpredictably. Now, you are under no obligation to transact with Mr. Market on any given day. You may simply observe his offers, note them, and continue with your own life. His moods tell you nothing about the underlying value of your business. They only tell you about his current emotional state. This is how you must view the stock market, especially during a crisis. Prices will swing wildly. Headlines will proclaim disaster one day and recovery the next. Commentators will issue confident predictions that will prove entirely wrong. Through all of this noise, you must maintain your own assessment of value and your own discipline of behavior. The defensive investor does not try to time the market. They do not sell in panic or buy in euphoria. They establish a systematic investment program and follow it regardless of Mr. Market's moods. They understand that short-term price movements are noise and that long-term value creation is signal. Create written rules for your investment behavior. How much will you invest each month? Into what funds or assets? Under what circumstances will you deviate from this plan? The answer to the last question should be almost never, and only for life changes, not market changes. Asterisk, asterisk, step 5, consider enterprising opportunities only with strict criteria. Asterisk, asterisk. This final step is not for everyone. Indeed, it is not for most people. The enterprising investor seeks opportunities that require more analysis, more effort, and more judgment than simple index investing. They might evaluate individual stocks, seek out undervalued assets, or pursue more complex strategies. But enterprising investing is only appropriate for those who have fully secured their foundation. All previous steps must be complete, toxic debt must be zero, emergency reserves must be robust, defensive investment must be well established and systematic, and even then, the enterprising investor must apply the margin of safety concept with rigor. No investment should be made unless the price is substantially below a conservative estimate of intrinsic value. No concentration should be so great that a single mistake creates permanent damage. No leverage should be employed in pursuit of higher returns. Most people reading this should remain at step 4 indefinitely. Defensive investing, properly executed over decades, will create substantial wealth with minimal risk of ruin. The desire to move to step 5 often reflects impatience or ego rather than genuine analytical advantage. Be honest with yourself about your motivations and capabilities. The order I have presented is not optional. Each step creates the foundation for the next. Skipping steps or reversing the order reintroduces the fragility that the framework is designed to eliminate. The person who invests aggressively while carrying toxic debt or who speculates without adequate cash reserves has not understood the lesson. They are gambling, and gambling during a crisis is the fastest path to financial destruction. Let me now provide specific rules that you can apply to your own situation. These are not predictions or guarantees. They are decision criteria based on the principles we have discussed. If your household has no cash reserve covering at least 1 month of essential expenses, then you should not be investing at all beyond any employer match in retirement accounts. Your first priority is building that reserve. Every dollar should go toward cash until you have this minimal buffer. If you carry any debt with an interest rate above 10%, then paying off that debt should take priority over investing beyond the minimum required for an employer match. The guaranteed return from debt elimination exceeds any prudent expected return from investment. If your income is unstable or your industry is experiencing stress, then your cash buffer requirements increase. Consider targeting 6 to 12 months of expenses rather than 3 to 6. The greater your income uncertainty, the larger your margin of safety must be. If you cannot state in writing, right now, exactly how much you owe to each creditor and at what interest rate, then your first task is not investing or paying debt. Your first task is gaining complete visibility into your financial situation. You cannot optimize what you do not understand. If you find yourself checking investment prices daily, or if you feel strong emotions about market movements, then you are likely not ready for enterprising investing. These behaviors suggest speculation rather than investment. Return to defensive methods until your psychology is more stable. If you are investing borrowed money in any form, stop immediately. This includes margin accounts, borrowing against home equity for investment, or carrying credit card balances while contributing to investment accounts. Leverage speculation destroys wealth far more reliably than it creates wealth. If your investment decisions are based on recent price movements, tips from friends or media, or feelings about where the market is heading, then you are speculating, not investing. Speculation requires either special information or special luck. Most people have neither. If you have never written down your investment strategy in clear, specific terms, do so before making any further decisions. A strategy that exists only in your head is not a strategy. It will bend and shift with your emotions. Only written rules provide consistent guidance. The purpose of these rules is not to make investing complicated. The purpose is to protect you from yourself. The greatest threat to your financial well-being is not the market or the economy or even your debts. It is your own psychology under stress. These rules create structure that survives when your emotions do not. Let me share another brief illustration. Consider a person with stable employment, 3 months of expenses saved, no debt except a fixed-rate mortgage at 4%, and a strong desire to increase their investment contributions during a market decline. According to our framework, this person has completed steps 1 through 3 and is operating in step 4. Their desire to invest more aggressively during a decline is understandable. Prices are lower, the mathematical opportunity is real. But I would counsel caution. First, Their cash reserve of 3 months is minimal. Before increasing investment contributions, I would suggest building this to 6 months. The crisis that created lower stock prices may also create employment stress they have not yet experienced. Second, increasing contributions during a decline is prudent. Trying to invest a lump sum at the perfect bottom is speculation. The difference matters. Continuing or modestly increasing systematic contributions is discipline. Waiting for a specific price or making a large bet on market timing is gambling. Third, the emotional intensity of their desire is itself a warning sign. Investment decisions driven by excitement about opportunity may be driven by fear of missing out rather than genuine analysis. The disciplined investor maintains their strategy regardless of market conditions, neither reducing contributions in fear nor dramatically increasing them in excitement. The right approach for this person is to continue defensive investing systematically, perhaps modestly increase contributions if their cash flow allows, build their emergency reserve somewhat higher given the uncertain environment, and wait patiently. No dramatic action is required or advisable. I will now outline a practical plan for the next 30 days. This plan assumes you are starting from uncertainty and wish to establish a sound financial foundation. Adjust the specifics to your situation, but follow the sequence. Asterisk, asterisk, week 1. Complete visibility and stop the leaks. Asterisk, asterisk. Your first task is to know exactly where you stand. This week, gather every financial statement, every bill, every debt obligation, every source of income. Create a simple document that lists each item clearly. For debts, record the creditor, the current balance, the interest rate, the minimum payment, and whether the rate is fixed or variable. Rank them by interest rate from highest to lowest. For income, record all sources and note any uncertainty or variability. If you receive irregular income, calculate a conservative monthly estimate. For expenses, review the last 3 months of spending in detail. Categorize each expense as essential, optional, or wasteful. Essential expenses include housing, utilities, basic food, insurance, and minimum debt payment. Optional expenses include things you value but could eliminate if necessary. Wasteful expenses are those that provide little value and have persisted through inattention. Begin eliminating wasteful expenses immediately. Cancel subscriptions you do not use. Reduce spending that occurs by habit rather than intention. The goal is not deprivation, but optimization. By the end of week 1, you should have complete visibility into your financial situation and should have stopped obvious leaks. Asterisk, asterisk, week 2, build the first layer of emergency cash and explore optimization opportunities. Asterisk, asterisk. This week, open a separate savings account if you do not already have one. This account is exclusively for emergency reserves. It should not be easily accessible for daily spending. The psychological separation matters. Begin directing available cash flow into this account. Even small amounts matter. The goal this week is to establish the habit and begin the accumulation, not to complete the reserve. Also this week, contact creditors for any high-interest debt to explore options. Ask about balance transfer possibilities, hardship programs, or rate reductions.